Ratio analysis. Introduction. What is ratio analysis? The relationship between two or more variables that are taken from balance sheet or profit and loss statement is ratio analysis. Ratio is in general expressed either in percentages or in proportions and sometimes in pure numbers. Bankers deal in four different types of ratios, namely liquidity ratio, solvency ratio, activity ratio, and profitability ratio. Liquidity ratio is used to evaluate the liquidity of a firm. Solvency ratio is used to find out the firm's capability to raise a long-term loan with their own net worth. Activity ratio is made to know the efficiency with which assets of a firm are put to work. And profitability ratio is made to find out how profitable a firm really is. We will now examine ratios in each of these categories that we have seen. So first we will take a look at liquidity ratio. Liquidity ratio is a ratio which indicates the firm's liquidity and is quick ratio or acid test ratio, current ratio, and net working capital. Quick ratio is quick assets by current liabilities. So it's a ratio between quick current assets and current liability. It reveals the capacity of a firm to pay off current liability of urgent nature. Normally, quick ratios are cash or bank balances, receivables under 1 year, quickly realizable securities, etc. Next, what is current ratio? Current ratio is ratio of current assets divided by current liability. It shows the relationship between current assets and current liabilities. It reveals the liquidity position of a firm in the course of an year. Next is net working capital. Is the difference between current assets and current liabilities. It's a concept which reveals whether a firm meets the working capital needs of the borrowers. It is surplus of long-term sources over long-term uses or overlays. Next it is solvency ratio. So the long-term solvency of a firm can be revealed by this ratio. Important ratios in this class are debt equity ratio and debt service coverage ratio. So debt equity ratio is long-term liability by tangible net worth. This ratio shows the dependence of a unit in long-term finance. In other words, a debt equity ratio of 2:1 is desirable by most banks. Next is debtor service coverage ratio. This ratio is net profit plus depreciation plus annual amount of interest charged on long-term liability divided by annual amount of interest charged on long-term liability plus annual amount of interest payable on long-term liability. So this ratio explains the relationship between funds available for long-term liabilities in terms of interest and principal payments and amount of installment and interest. Generally, debt service coverage ratio of 2 is comfortable for banks or financial institutions. Next is activity ratio. So this ratio reveals the firm's efficiency to deploy funds raised on a short-term basis. The main activity ratios are debtors turnover, inventory turnover, fixed asset turnover, current assets of working capital, debtors velocity, creditors velocity, raw material holding, and stock in process. So debtors turnover is sales by average debtors, which is the average of opening and closing receivables. Inventory turnover is sales by average stocks, where average is taken as average of opening and closing stock. Fixed assets turnover is sales by fixed assets. Current assets of working capital is capital turnover is net sales by current assets. Debtors velocity is average book debts by sales into 12. Creditors velocity is average creditors by purchases into 12. So debtors velocity is an indication of how long firm takes in recovering the amount of credit sales. So there is a debt average book debts, which is basically sales on credit. So how much it takes to recover those amount of credit sales, that is debtors velocity. Creditors velocity is average creditors by purchases into 12, which is a pattern of payment of dues to sundry creditors. Raw material holding is stock of raw materials by raw material consumed into 12 months in a year. Stock in process is stock in process by cost of production in a year into 12. So this completes activity ratio. Lastly, it is profitability ratio. This ratio reveals the efficiency of an organization to generate income and surplus for a firm. So the main ratios are return on investment, which is profit by investment into 100. It is actually a measure of how much an organization earns on its capital employed. Return on equity, which is net profit by owned funds into 100, which is actually earnings based on funds provided by promoters or shareholders or funds retained in business, retained earnings, and whatever it generates. Gross profit is gross profit by net sales into 100. Net profit is net profit by sales into 100. Operating profit is operating profit by sales into 100. Operating profit is a margin of profit on operations and reveals efficiency of a firm. So this completes a session on ratio analysis. Thank you.